Hi everyone, I'm Mirela Ciobanu, lead editor with the papers. Welcome to Leadership Insight Talks. We continue our series of videos that aim to bridge the knowledge gap between traditional finance and DeFi. This year we are going beyond the buzz to show real use cases of how digital assets are transforming the financial industry. Digital money is creating new opportunities for treasury and liquidity management. Instead of leaving settlement balances idle, financial institutions can increasingly put capital to work while maintaining operational readiness, provided they can manage the associated regulatory, operational, and technology risks. But how to unlock this opportunity? Today I'm joined by Adam Levine, CEO of Fireblocks Financial Services, who will explain how liquidity management works in traditional finance today. How can institutions put idle balances to work? What exactly is a DeFi lending protocol, and how does it work in practice? What is the current attitude of traditional financial institutions towards on-chain lending? And what is Fireblocks' role in supporting the DeFi ecosystem and the challenges ahead? Fireblocks Financial Services is the dedicated division housing Fireblocks regulated licensed services businesses, which include Fireblocks Trust Company, a New York chartered qualified custodian purpose-built for institutional digital assets. Adam has led Fireblocks Trust Company since its launch in 2024. He also serves as the head of corporate development at Fireblocks. Adam joined Fireblocks from BNY Mellon, where he headed the digital partnership team, responsible for leading strategic investments and partnerships with emerging technology companies. Adam, so happy to have you here with us.
Excellent. Thank you, Mirela. Really excited for us to be speaking today.
Yeah, and before we discuss digital assets, would you explain how liquidity management works in traditional finance today?
Absolutely. Liquidity management is essential for corporates and financial companies. It's really about ensuring that you have the appropriate amount of the currency you need at the right time to fund your obligations. Most of the time, this is ran by a CFO or their office, and it is really essential to make sure they're paying their employees, paying their vendors, being able to make the appropriate payments on time. And so the CFOs are constantly thinking about managing those funds, and their goal is not to index towards return as much as have the funds kept safe, be available, and then they start to think about if there's a way to generate some returns on them. So it is not meant to be a risk-on exercise as much as ensuring for the core of their liquidity that they have it available at the right time, and then of course for their reserves that they don't need as urgently, then they start to think about how they can deploy that capital in a way to generate some return.
So what I hear from you is this idea of keeping them safe, having them available. So in a way, this kind of means, idle capital. So why do institutions still maintain these large idle balances?
Yeah, they're doing it first because they want the funds available as soon as they need it, but also for a variety of reasons. A lot of them are operational in nature, where it's difficult for them to quickly move their assets from a fiat to some version of a yield-generating return, right? Like a money market, for example. Many of the traditional financial institutions that are looking at providing treasury solutions aren't able to move funds at the speed of the internet, right? Everyone talks about digital assets and blockchain moving quickly. But when it comes to the traditional yield generating offerings, those move slower. There's often some friction and cost. And therefore, CFOs and the treasury teams are going to err often on the side of having the fiat available at the expense of being able to get a better return on those capital.
So one of the biggest promise of digital money is this fact that they can help these institutions with returning yield and improve capital efficiencies. How can these institutions put the idle balances to work while still ensuring they have sufficient liquidity when payments need to settle?
Yeah, the beauty of blockchain is the speed with which it is able to move, and that's fantastic. And then the next step that treasurers are thinking about during this time is what could they do to generate some yield, and how is it different if I'm using stablecoins as opposed to regular fiat currency? And now there are much more mature answers than there have been in the past of ways that you can still generate appropriate yields and be able to get your currency when you need it to make payments. The first is really boring, but also really fundamental when we think about items like tokenized money market funds. I say it's boring because they're low risk, low yield, but the beauty of these being tokenized is we're starting to see institutions that have 7, 8, or 9 figures of assets of money at rest throughout the day. And for them, if they're able to move into those tokenized money markets, generate a return that's still relatively low risk, for those hours where the funds are idle and then convert it back to a stable coin and make payments throughout the day, that's a big innovation that doesn't really exist today in traditional finance. The second thing is thinking about DeFi lending. And again, depending on the risk appetite of the treasury team and the CFO, there's different type of liquidity pools where institutions can choose to take their stables and deploy it into those DeFi pools. The level of sophistication of the curators, really the financial engineers behind each of those pools, has significantly increased over the years. And it gives treasurers the opportunity of thinking from a very low risk to a higher risk appetite where they can generate some yield. Depending on the type of institution, the amount of funds at capital, they will likely deploy between one of those two options if they're now leveraging stablecoins to make their payments. Therefore, they get the benefit of moving funds faster, the benefit of accessing yield generating returns, and have different options of risk appetite and level of return they'll get on the otherwise idle cash.
So from what you are presenting now, I see kind of two worlds. So we have the traditional finance, and now we have a new way of moving money. We have this idea of keeping things more safe, but then we also have this idea of having a higher risk, but maybe higher returns. You mentioned the TradFi, and then you also mentioned a bit of these pools that are part of a DeFi protocol. So how these two worlds are coming together? What is the bridge? So how is because most of our audience has a traditional background, let's say in finance, and how do we present to them this new world of the DeFi protocol? What are its elements, and how can these two worlds be connected? So now we go back, but with me explaining like I were a 5-year-old.
Yeah, when I think about this, the maturity that we've seen in the market is that it started off with those crypto native institutions, the crypto bros, if you will, people that were very risk on, and that's not the story that we're focused on, right? What we think about, and the reason why I get so excited about digital assets, is because you're able to conduct commerce quicker, with less risk, and many times cheaper, right? And stablecoins is a great example of that. And so what we see now are large institutions that have nothing to do with cryptocurrency, that are realizing if they want to move funds cross-border or just even within their domain, if they want to do it quicker, stablecoins give them that option. And so the first evolution was them thinking about why stablecoins can make sense, how they're able to limit the risk and the dependency that they may have on correspondent banks and those charges. And once they have that moment of enlightenment, they're next thinking, great, I get the efficiencies, but I still have some capital at rest, right? What else can I do? That's where we see extending to money market funds. And when we think about money market funds, it's very traditional companies like BlackRock, WisdomTree, Franklin Templeton, blue blood names that are very well known in the industry that are offering money market funds on chain. And so when you think about it from a traditional finance perspective, which is my background, I see the opportunity of less risk with making digital asset payments, still being able to access yield from these money market funds that are still very low risk, right? They're US dollar denominated money market funds from traditional asset issuers, right? That's exciting. And then from there, we start to see some institutions that say, I have a lot of funds at rest. Some of them I may want to generate a higher yield. Some of them I may want in money market funds. Some I need ready to deploy in moments. And you now can do all three of those things with stablecoins and digital assets. And so it doesn't mean you have to jump into a very far deep end of crypto and high risk. It's actually those traditional players and corporates that start to get the benefits immediately by conducting their existing business, but doing it in a different way.
Yeah, in a way, you kind of anticipated my next question because I was, curious who are those companies that can put this idle capital at work, not necessarily companies that may want to make a profit out of it, but the most common ones. And you mentioned the traditional player like corporates. Can you elaborate a bit on some, I don't know, use cases or projects you have been working, how it started, how the conversation started, what were
Yeah.
their challenges, needs in the beginning, and then how they ended up reaping the benefits?
Absolutely. So one of the innovations that we see is that people, corporates rather, are looking to move funds cross-border. Everyone's heard the cliche of the stablecoin sandwich. It's very well known, where you start with fiat in one jurisdiction, you end up with fiat in another, but to get there, you're using stablecoins to convert from an on-ramp onto the blockchain and then an off-ramp in the next jurisdiction. This is traditional FX, where institutions have their domestic currency and owe a fund in a foreign currency. In traditional finance, you're leveraging correspondent banks. It means that you as a corporate now need to instruct your bank to move your currency into another currency. Many times those institutions need a correspondent bank in their domestic jurisdiction, and then they have to rely on that bank's partner in the foreign jurisdiction to convert into the right currency. And this settles, generally speaking, what's called T+2, or 2 days after settlement. Corporates have come to us, very large corporates that can get the who's who of global banks, and have said, how could I do this quicker? How could I do it without increasing risk? And will I be saving funds? Right? And when I think about those three value drivers, those are really the things that we're looking at. More efficient use of liquidity, reducing the risk related to payments, and in many cases, doing it all cheaper. And so corporates have come to us showing the types of payments they need to make in maybe a dozen or more jurisdictions, right? So they're thinking about having to get foreign currency across the globe in many jurisdictions and seeing how that process works with stablecoins, right? And that's where they get that Buddha moment of enlightenment, where they see that they can move their funds without necessarily needing to rely on the same correspondent banks. And this isn't to say banks are bad or banks are disappearing. I think many banks are starting to see the benefits and are actively talking to us about how they can leverage the technology to support their clients. But to go back to your question, it's those corporates that see if they need to make payments in many jurisdictions and they could do this with a different level of dependency and more efficiency and less risk, that's where they get excited. And then they have the question of, do they do that themselves and leverage someone like Fireblocks for the technology, or do they want us to do it for them? And that's where our financial services unit comes in, where we can help with the right licensing, facilitate the payments at their instruction.
So in a way, you describe the best case scenario where somebody has a problem and comes to you and they see the benefits and are convinced. But I have the feeling that at the other end of the spectrum, you also have people that are more reluctant to embrace this way of moving money, or not necessarily reluctant, but maybe they need more education, or maybe they are more risk averse. Can you also, share a bit about the insights that you find on the other side?
Of course. So what we often do is when we're speaking to clients, first, we're always happy to educate the market, but we're not out there trying to convince people there's a problem when there's not. But what we often do is ask questions, right? How are your payments being made today? And generally speaking, institutions are happy, right? They think it works. But when you start to probe questions like, well, how often are there failures? And how long does it take you to be notified of a challenge with a payment? And are there costs that you're associated with that? Not just penalties or fees, but are your funds not in the right place at the right time? Are you not getting a yield on them when you could have been? How many hours is your operations team spending and talking to your finance team about that? And as you start to probe with clients, you start to see that, of course, it's not perfect. It works very well today, but there are opportunities to do it better. And it's not just the third and fourth tier corporations that can't get access to an HSBC or Citibank. oftentimes it's those larger companies with very sophisticated treasuries that were able to really understand the magnitude of what they're trying to achieve. And there's sometimes death by a thousand cuts. Sometimes there's very specific corridors that are really painful or difficult for them. And so it's through those questions that it often comes up where we understand, they start to understand some of the challenges. And look, we'll be very clear, stablecoins isn't the panacea that cures everything, but there's very good use cases of why it can make sense. And there's many times where you need to get into fiat. And look, we're not radicals. We're not trying to convince people to get rid of fiat, but to understand that you can conduct your existing commerce today in many instances with the benefits of doing it on a digital asset. That's the unlock that we get excited about. And we could point to many financial market infrastructures and leading banks, not just running POCs, but starting to deploy in a meaningful way so that they know we're not a bunch of lunatics, but we're actually working with the heavily regulated institutions, the public companies that have scrutiny. That's the bar that we set when we work on projects.
Yeah, and since you mentioned that, indeed, we've been following you, and yeah, you are all the time also watching what is also happening on the compliance side. And since you mentioned a lot about DeFi lending yields, these are more, let's say, financial products than payments per se. How does the current regulation impact also this story on generating yield and being able to provide more sophisticated financial products than payments?
Yeah, what's clear is that globally speaking, you're seeing increased clarity, no pun intended, on what institutions can and can't do when it comes to digital assets, right? And although I'm American and work in New York, whenever I travel globally, we always get the question of what's DC doing and how is it going to work? Obviously, there's a strong impact that the US economy has on the industry. But we're seeing in many jurisdictions that increasingly institutions understand where and how they could participate. And even in the US, it's moved miles over the last few years, where while regulation is not finished and not necessarily sufficiently clear for many, it's less and less the impediment. Right? When you look at large banks, financial service institutions, financial market infrastructures, and payments companies, many of them are already leaning in. And what I find is some of the laggards are the ones that are pointing to regulation as the challenge. But we also know at any large institution, if they're looking to make a meaningful amount of payments in a new way, especially on blockchain, it's a long project. Not because deploying the technology is difficult, but they have risk, systems, change in talent, change in operational procedures. And so we definitely see that the leading institutions are already committed to projects and leaning in now. Many of them are live. Some of them have target timelines. Of course, when there's more and more clarity of US regulation, we'll see the US market move. But we're seeing in other markets where large institutions are starting to move a meaningful amount of value on blockchain and therefore starting to deploy in things like the tokenized money market funds.
Yeah. Since we talk a lot about large financial institutions, we talk about markets, we have this idea of a global impact. Fireblocks is a specialized company in providing the rails for this new digital economy. However, I have this feeling that you are not doing this alone, that you also are part of ecosystems and are also encapsulating other players. And recently you announced an integration with Morpho and AV. Can you tell us more about this partnership and how does it integrate to our story today?
Of course. So Fireblocks is very good at lots of things, but we also know where it's appropriate to partner, and that's where we partner with the best. We definitely work within the ecosystem, and it takes many for all the innovation that we've seen. So a few months ago, we did launch a partnership with both Morpho and Aave, and this was a way, in a very safe and secure way, through the Fireblocks integration, for our clients to access these lending pools. So it's specifically starting with stablecoins. And this is something that's more risk on than a money market fund, where they have an opportunity for potentially a higher yield, and they get to deploy their assets into these vaults. You could think of the vaults as different investment vehicles. They get the clarity, our clients get the clarity of the type of return they're targeting and how the investment process works. Morpho is a technology infrastructure that allows for the different pools of liquidity to be invested. And then there's things called curators, the financial advisors, financial engineers, institutions like Galaxy and Centaur are some of the ones that we've partnered with that have their own vaults or their own pools within Morpho. Aave has a similar system where they do this all themselves. But that integration has allowed our clients in a very safe, secure way, in a few clicks, deploy some of their assets there. The trend that we're also seeing now from many fintechs and neobanks is that they want versions of this program for their own clients. And that same opportunity is available when leveraging Fireblocks, and the connectivity to Morpho allows them to generate programs for their end users. And that's been a big area of growth as well.
So it seems that there is a lot of contamination in a positive way of, more corporates adopting these DeFi protocols. And looking 3 to 5 years ahead, do you expect capital efficiency through programmable treasury and on-chain lending to become a standard capability for financial institutions, or will remain a niche strategy, though from what we are seeing now, probably not for digital asset native players?
Yeah, look, I had an opportunity to speak with the CEO of a very successful asset manager. And what he said to me is 5 years from now, their whole business will be curating pools in DeFi. And this is someone that comes from a traditional background, and perhaps a bold statement, but 5 years is a long time from now. We very much see that the future of finance is moving on chain for all the reasons that we mentioned. I do not think that there are going to be crypto companies in the future, the same way there's no internet companies now. It's going to be digital assets will be a component of how institutions conduct their business. And when they want to deploy their capital, they're clearly going to be looking for different investment strategies. And doing that on chain will be the way with which they do that, because it's going to be quicker in the way that their clients, their banks expect. Now, some of that may be DeFi pools and lending and more risk on. Some of them may be just buying traditional instruments like the money market funds or private credit, but all of that will be on chain.
Yeah, that's nice that in a way, even if it's a bit of a technical discussion, you put it so into this narrative of a natural evolution of the financial services and how, big financial or corporate institutions operate. Because we won't probably speaking about off-chain, on-chain, and all these digital assets. It's like, you mentioned with the internet. We just naturally use it without actually thinking about it.
That's exactly right.
Great. Thank you, Adam, for today's discussion, and I look forward to catching up.
Thank you for the time. It's great to speak with you.